All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. This morning for the challenge, went to all cash, and JP Morgan hit its stop level. Halliburton had had a nice shot down, and GOLD had hit our price target and then backed off it a little. If GOLD were a new position or something, I probably wouldn't have exited it, but just decide I'll take it off. Give us a quick reset. We haven't had one of those here in a little bit, and we're able to go out and attack the next signals. And I mentioned this morning I expect that there are some signals on the board here this afternoon, and hopefully we see some of the implied volatilities die down a little bit and offer some nice entry points, right? And let's go take a look at it because there are three entry triggers on the board right now. We have let me get the dates right here. We have Nike, we have JP Morgan, and we have MGM, and they are all triggering bearish. Now, I'm not going to go buy a single one of them, right? I'm not going to buy a put on any of them. I'm going to invoke, rule number 11 here. When a new signal is triggered and the option is more than 10% the norm, Jeff has the option to wait 2 sessions to trade it. Here's the thought process, right? And let's just come into Nike, for example. Here's Nike. And let's just say, for the sake of argument, the market isn't going to bounce back into the close, and Nike isn't going to close higher than where it does right now, which I do think is a good potential that we do see that. But take a look at the Vega. It's 10 cents on a $2 option, and the implied volatility is about 2 points higher. So, let's just say Nike decides to rally 20 to 50 cents Monday morning. This option value is going to be 20 to 25% less just because of the implied volatility. You add on the time decay or the theta onto that, right? And you're talking 5 cents. Some of that's going to start to come in this afternoon for the next 3 days, and so you're talking about an option that is about 30 to 35%, or 30 to 35 cents too expensive with a 5% spread on it. So it is one where I have to almost assume a 20% loss just on my entry, right? And I better be right. I better be right in a big way, or else I'm not going to see real return here on this option. Now, if I am right, and Nike does move the two average two ranges, it's more than a double, right? It's not like the option is unfairly valued for if it's going to make a move to the downside. But the risk reward element with the implied volatility is not balanced the way that most entry trades are. And that is the case for all three, MGM, Nike, and JP Morgan, here this afternoon. Now, it's also the case for a lot of stocks out there on both the call and the put side, right? We have seen the implied volatilities rise, and we can see in the VIX, it's up 13% today. We have a significant rise there, and what does that mean? It means option values are just more expensive, and we have to take that into account. It doesn't mean that you don't go buy them if you think something's going to go or anything like that. No. But it is a higher risk scenario. And it's a risk scenario where if you're on the put side and you're wrong, that risk is significant. And if you're on the call side and if you're on the call side, even if you're right, you may not make as much money as you thought you would, given a normal, time period. Now, probabilities of bigger moves are simply higher, right? They're simply higher, and that's what the market is doing and pricing in. So for the challenge, I'm going to take a look at each one of these Monday, right? See where the option values are, see if the risk-reward element, holds up there. But for now, invoking a rule number 11. Now, I know I'm going to get asked this, so I'll answer it before I get asked it. Would these be bearish triggers with the algorithm that we've used the last two challenges? And the answer is no, they would not be. Right, but I mentioned for this challenge, I'm going to loosen up the bearish triggers because I've had them extra tight. Right, I've had the bearish triggers extra tight, just simply because we are in a general bull market. Right, and that has served us well to have that element a little tighter. But I have loosened it for this challenge, and am aware of that, and that's also there. Does it really matter all that much? If the option values were strong, I'd be going and getting in, setting up the risk reward, and going, right. But with where it sits, I am going to give it the weekend and see what transpires there with it. All right. Now on the downside crossover list, there are a lot of names. It is a huge list. There's not a single name on the upside list, but here's the downside list here today. 18. I guess if you take out the SPY and the FXI, there's 16. So it's not as big as it looks right here, but a lot of downside crossovers. Some things, do we get a downside crossover and then get a nice little upside uptick to give us a buy signal? We could. But things like Amazon, coming off of highs aren't going to give signals. I thought Conoco or Chevron had a chance to give us a signal today, but consolidation risk on them is a little too high, and I was a little shocked to see that, or surprised to see it, not shocked. But things like Micron, Microsoft, there's just no real chance of setting a signal there. Here with those stocks. So that's where things are and how they're trading. You'll notice GM is not on this list. I was kind of hoping that would be on the list. I'd love to go trade that to the downside, but it doesn't have the crossover to give a signal here today. All right, so gonna go into the weekend with the challenge at 6,500. And, in all cash here now. So we made a decent jump. We finally, this week, we broke out of that, that range there between kind of that 3,500 to 4,500 range. We broke out of that range here. Hopefully we don't go back and revisit it, but it does put us in a position to, have 2,000 to 2,500 into each position, which is significantly larger than we've put into any position so far. Our largest position so far was JP Morgan, right? And that was 1,700. Outside of that, we had GOLD, which was, 1,500 in the original position. So, they've been growing in terms of size with the account value going up. But it will be nice to get into that $2 to $3 area per trade, and start to see a few of those gains locked in, and that pushes up to that 10K mark here with the next round of trades. All right. Now, big down day in the market, right? Big down day in the market. What's going on market-wise? Do we see a big shift? Are we seeing, big massive change or something of that nature? Let me show a couple things. We see an erosion in the market vibe. The market vibe has turned neutral. Okay, where the eroding factors are in the shorter term factors. They're in things like the number of stocks below the 7-day moving average. This number has fallen from 50% yesterday to 32% today. This has had a pretty sizable drop in the last 2 days, and so has kind of gone into a little more of a bearish territory. If we look at the number of stocks above a 20-day moving average, you'll notice that it has moved on down more into a neutral territory than a bullish territory. So we see some of those moving average shifts. The volume flows have also shifted. So the market vibe has shifted from bullish, which it triggered. It triggered bullish right back here, and has shifted into neutral here with today's action. Now it hasn't shifted bearish. There's some good arguments to be made for bearish, but you'll notice something like the FXI not really selling off today. We do have the IWM, but where the change in the market is right now is in the performance list, right? It's in the stocks that are moving here today. The sector summary, and if we pull up a sector summary and we take a look, real estate's on top. Consumer staples on top, utilities on top, and healthcare on top. You'll notice the more conservative sectors, they're all on top. Materials, not really changing all that much today. Why? Well, gold's helping it in a big way. And it's a pretty small sector. But how many sell-offs in the market in the last year have we seen tech leading the sell-off? And not just leading the sell-off, right? It isn't just leading. It is the sell-off. Right, tech is the sell-off. Communication services, right, down 1.6. Consumer discretionary, well, that's because of Amazon, which is pretty much a tech company. So when we look at what's lagging and the performance differential today with tech, it is massive. You add that to what we saw yesterday with tech, it's huge. We have not seen tech get beaten like a rented mule like this for quite some time. And not only that, but how the other sectors are holding up, right? Tech is down 2.5%. Financials, yeah, they're down, but they're only down 1%. Industrials, they're down 0.5%, right? So it's one of those where we continue to see the market have a high level of differentiation when it moves. When it moves up, it's not all stocks going up. When it moves down, it's not all stocks going down. There is a high level of differentiation out there. And the sell-off right now and the fear factor right now is tech. And that's where a lot of the gains have been, here during the course of this year, and that is where a lot of the overinflated values are. But if you look at the New York Stock Exchange today, there are only 1,100 more stocks that are declining than advancing. That's nowhere near the numbers we saw in January. That's nowhere near some of the other dip numbers that we've seen. This isn't a day where you look across the board and everything's red. It is a day where there is still a lot of differentiation, and there's still a heavy, heavy sell in tech. Now, why do I bring it up? Now, because a lot of times when you see a day that's red like this, there's this natural tendency, and I do it as well, to take a look at individual stocks. And you take a look at a UTX, it's holding up well today. You look at a Johnson & Johnson, it's holding up well today, right? I mean, these are stocks that are performing pretty well. And you say, well, down market stocks are performing well. Should I go buy them? If we're going off of that thesis, keep in mind that the market was up on Wednesday, and it was up nicely on Wednesday, and J&J was in the red, and UTX was in the red. Just keep that in mind, right? This isn't a vacuum. And these are stocks, UTX and J&J, that have been hit pretty hard in the last 2 weeks. And, okay, yeah, that they're not seeing the heavy sell pressure today. The heavy sell pressure is in, the tech space. So do you go buy these? Do you pop them on your watch list? If you're going to go buy them because they're up today on a down day in the market, I think that logic is very flawed, and we can kind of show how that logic has not proven itself out in many cases. But if you want to go buy them, right? If you want to go buy them, there's a trade set up here. Meaning you can buy UTX with a stop on today's low. That sets up an interesting risk-reward. We have a stock that's sold off about $7. It's firming. It's closing above yesterday's highs, which you hear me talk about a lot, right? Well, when do you start getting interested in buying a sell-off? Well, when it closes above yesterday's highs. We have that for UTX, right? We have a nice little bullish engulfing candle. We have a nice little risk-reward playing off of yesterday's or today's lows. That's the reason I would be a buyer, not, well, it's up on a red day in the market, because that's not the way the market works anymore. With bonds, with the whole kind of rotation elements thrown out the window with the market works as rotating within itself. And we are seeing that today in a big way. It is rotating through itself. And in general, industrials, they're seeing, some buy pressure here today. Yeah, Boeing is lagging, right? Boeing is lagging a little bit. But outside of that, you look at some of the things like JPM, it's only down 1%. You look at Honeywell, it's down 0.3%. You can't even really tell what's going on in the market when you look at Honeywell, right? So to go out and say, well, I'm going to buy UTX, or I'm going to buy J&J, or I'm going to buy Lennar, for example, right? These stocks that, well, Lennar's not green anymore, but Caterpillar. I mean, Caterpillar's green, right? To say, well, I'm going to go out and buy these stocks because they're up on a down day in the market. Well, take a look at the volumes. They're not all that great. But all right, you want to buy them. Today's low is the stop point, and you do have a chance that it goes up. Are they going to go up because they were green on a red day? No, that meant that idea. Yes, back in 2008, 2009, even through 2013, when it was everybody into the pool and everybody out of the pool, that held water. But over the last 5, 6, 7 years, we have seen that element really erode and not be very valid in terms of, well, this stock outperformed today. Well, what do we normally see? One day's outperformer becomes the next day's laggard. That has been more normal than, looking and going, well, this is outperforming today, so you know what, it's going to, move on higher. Right? So, all that said, I don't mind the trade. I don't mind the setup. I don't mind any of that. In fact, it's enticing, and I get it. But to want to be a buyer because it's up on a green day or on a red day, I think that's quite that's a stretch that I'm not willing to go out there and make. And we can just look at it and say, how did that philosophy work 3 days ago on Wednesday, or 2 days ago on Wednesday? Well, the market was up nicely, UTX was down, and had you bought puts on it, you're sitting there in the red, and you're going, wait, the market went down a whole bunch, and my puts didn't perform. Right, and that's where you're kind of sitting at, not a good, comfy feeling. And so to use that exact same philosophy on the other side right now, just trade what you see with the individual stock and go. But to use a stock performance relative to the market in this environment doesn't make sense. Will we ultimately go back to everybody into the pool, everybody out of the pool, where some of these differentials will make some sense and will be tradable? Yes, we will. Eventually, I do believe the market gets back there, but it's not a place the market has been for several years, and simply not a place where it is, right here and right now. And I know I'll get a comment if UTX goes up, Monday. Oh, see, it was up today, so, well, yeah, UTX could go up Monday. But it's not going to go up Monday because it was up today. It's just, yeah. Anyway, but I've said my piece as far as that goes, and I appreciate the one who brought up that up to me here today. Okay, one of the reasons Caterpillar's up, right, and one of the reasons industrials are holding up today is Deere's earnings. Right, Deere reported earnings, and this is something I think is being overlooked right now. And if you come in and you look at what the report looked like relative to expectations, they beat on earnings, right? They beat on the earnings expectations, and on the revenue expectations, right? They beat on revenue. But this is a company that's going through losses year over year, quarter over quarter. They're into this loss period, and right now, investors are wondering, is the bottom in? Is the bottom in? I think there's some interesting arguments to be made on Deere's report that the bottom is in. And it may be, sunshine and roses for them after this with some very, very easy comparables. All that said, the comparables are still pretty sour when it comes down to both Caterpillar and Deere. They're not, comparables that are, super nice yet. So, yeah, can Deere get up to 200 or something like that? Yeah, probably, probably. But is it ready for monster upside breakout? I'd be surprised, but I would never put it past Deere. That the Deere is the last company I'd put it past, just the way it trades. But from me, I'm willing to be a buyer of Deere on pullbacks. I'm not willing to chase rallies after this report, but it doesn't mean the report wasn't better than expected. In fact, it was significantly better than expected, and that is helping the industrial sector here today. Thanks for hopping on. Have yourselves a fantastic weekend, and we'll talk to you Monday. Take care.